On behalf of Finance Watch, I want to welcome you to this online conference addressing the subject of crypto assets, stablecoins, and central banks' digital currencies. I'm really delighted to welcome you to what promises to be not only a very interesting moment, given the quality of the panelists we have gathered this morning, but most importantly, a moment of reflection on an essential topic with potentially far-reaching implications for everybody's lives and the functioning of human societies. As we know, so-called DLT, in other words, blockchain technology, has emerged as a major technological innovation with many ramifications and implications for the financial sector over the past few years. In a most welcome move, the European Commission has come up with a proposal for regulation of markets in crypto assets, so-called MiCA regulation. And now is the time to reflect on how we want this regulation to be calibrated. There's a natural tension among policymakers to be seen as pro-innovation and act in favor of innovation. But starting like I do from the view that innovation is only a means to an end, and not an objective in itself, I would like in this brief introduction to contribute to feeding this morning's debate by asking probably three simple questions. First question is related to the fact that crypto assets are often presented as a way to address better the needs of retail customers and to foster financial inclusion. I would very much like to dig further into this question, and if I may, perhaps challenge the assumption that blockchain technology and its applications can actually address this issue. How and to what extent can crypto assets address the issue of financial inclusion, which one might argue is far from being only a technological problem? Second question is on a very different level. And it is the fact that we need to be confident that we're putting in place a system that will address adequately the issue of anti-money laundering and financing of terrorism. It is a well-known fact that crypto assets have been, and unfortunately still are, and all supervisors know that, a major vehicle of all the dirty money of the world. And we need to ask ourselves whether the rules, including the rules of supervision we're putting in place, address this issue properly. Far from me to say that crypto assets are only about that. Of course, it's not the case. Otherwise, we wouldn't be talking about it or trying to regulate it. We would be forbidding it. But it is a major dimension that needs to be addressed, and we have to reflect whether we're doing it properly. And I would say, last but not least, so-called asset reference tokens, which is the expression used in the proposed MiCA regulation for stablecoins, seem to have the possibility not to be fully backed by assets. In other words, to be leveraged. In other words, to become instruments that will create money. For instance, issuers of asset reference tokens would be able to back 100 euros notional value of a token with, say, depending on the decision, only 20 euros worth of assets, thereby creating 80 euros of new money. And all that with only an equity capital of 2 to 3%, depending on the size of the issuer. As we know, creating money is the privilege of banks and has major financial stability implications. Are we not creating here a new form of banks without calling them by their names? Are we respecting the well-known and very healthy principle known as same risk, same regulation? In other words, are we not putting financial stability at risk? Finance Watch obviously will be following the topic very closely, as you can imagine, and from financial inclusion to financial stability, this topic is so much as at the heart of everything we stand for at Finance Watch. Without further ado, because we have a big session this morning, I will now leave the floor to our panelists for the first panel and to my distinguished colleague Christian Stiefmüller. And I will follow, like all of us, the debate on these most important and interesting questions. Christian, the floor is yours.